Welcome to the 6th lecture of the course Mathematical Finance. And this lecture we will be talking about interest rate derivatives, and we will be covering chapters 13 and 14 of the book by Yoshi. I want to start with talking about interest rate swaps and options on interest rate swaps, because these are extremely liquid contracts that are, let's say, traded in the market, but they are not so well known because they are traded, let's say, in the interbank market, so directly between banks, and there is no exchange for interest rate swaps. But this market is extremely liquid, and it's many times more volume than the market for government bonds that people usually, or most textbooks, talk about when people talk about the term structure of interest rates. So what is an interest rate swap? An interest rate swap is a contract where we exchange between two parties fixed payments and variable interest rate payments on the same underlying amount. And the standard convention for euro is that the floating payments are semi-annual payments. So every 6 months you pay a variable interest rate, which is tied to the European Euribor. So that's the Euro interbank offer rate. And the annual payments, sorry, the fixed payments are annual. So there is a difference in frequency between the floating payments and the fixed payments. And since the credit crisis, swaps with an overnight floating lag, so basically every day, every working day, you are paying the 1-day interest rate, they have become more popular, and that market is growing. And those overnight interest rates, they used to be called Aeonia, but there has been a little bit of a restructuring in the euro market. So the market is moving, at least in the euro area, to the so-called ESTER, which is an acronym for Euro short-term rate. When we talk about interest rate swaps, because it is like a forward contract, because you are simultaneously exchanging something, you cannot say I'm buying something or I'm selling something, because two parties are simultaneously exchanging payments. So the naming convention is based on the fixed rate point of view. So when we talk about a payer swap, it means that from my perspective, I am paying the fixed rate and I'm receiving the floating. And when I talk about the receiver swap, then from my perspective, I am receiving the fixed rate and paying the floating. And obviously, what is a payer swap from my perspective will automatically be a receiver swap from the counterparty perspective. So what we will be talking about are payer swaps and receiver swaps, and the fixed rate, who is paying or receiving the fixed rate, that's the basis for the naming convention. What are interest rate swaps used for is they are, and because this market is so extremely liquid, they are used to quickly convert investments from fixed income payments to variable income payments, or from fixed to floating interest rate payments. And a combination of a short and a long, a swap with a short maturity and a swap with a long maturity can be used to very flexibly, let's say, change your duration or your interest rate exposure to long interest rates, from short interest rates to long interest rates, or from long interest rates to short interest rates. And it's typically, the swap market is so much more liquid than the underlying bond market that many professional parties actually kind of do buy and hold for their bonds, but then use kind of fine-tuning of the interest rate exposure by using interest rate swaps, and they basically don't touch the underlying bond position. So the swap market is extremely liquid. So if you want to do a single trade, you can basically do an amount of between 10 million and 250 million. That's €250 million. And the difference between a payer and a receiver swap, or the fixed interest rate that is quoted for a payer and a receiver swap, is for professional parties is 1 basis point. So that's 1/100th of a percentage point. And sometimes it's even half or 1/4 of a basis point. And what's interesting, or the reason is that this market is not so well known. People don't talk about this on the news, so to speak, is that there is no exchange where swaps are being traded. This is a completely interbank market that happens between brokers and Bloomberg screens. And the liquidity is also visible, is that for an enormous range of maturities, you can enter into these swap contracts. Swap contracts from 1 to 30 years are really standard and are ultra liquid, but it is possible to enter into interest rate swaps with maturities up to 60 years. And the liquidity is less for longer, for these very long maturities, but still there is a very sizable amount of trading going on every day, even in this very long maturity contracts. Let's take a look at a toy example. Suppose we enter into a 3-year swap with a fixed interest rate percentage of 3% and a notional of 1 million. So how does it start? Well, today I am now at time 0, and we basically, at the beginning of the contract, we observe the 6-month interest rate for the first half-year period. And in this example, it's 2.1%. And at time 0, we basically agree, or I agree with my counterparty to start with the swap contract, but at time 0, basically nothing happens. And then half a year later, it is a payer swap from my perspective. So after half a year, I am receiving €10,500. Why 10,500? Well, this is a 2.10% interest rate, which is quoted on a per annum basis, but it is a half year, or it's a 6-month interest rate. So I'm only receiving half of 2.10 times 1 million, and that's 10,500. And also after 6 months, we observe the new floating interest rate for the next 6-month period, which is 2.6%. And then we fall asleep again for another half year. And then at time t is 1, 2 payments are going to occur. I am receiving €13,000, which is 1/2 times 2.6% times 1 million. And I am paying €30,000. And what typically happens in the real world is we are not simultaneously making 2 payments, but the 30,000 and the 13,000, they are being netted against each other. So in this example, I would then pay 17,000 to the counterparty, and that settles the difference. And then we observe the 3%, and then we go on until the very last period. So at time t of 3, then the 15,500 in the floating payment is based on this interest rate percentage of 3.1%. And I am making the last annual payment of 3% over 1 million, which is 30,000. So you see that the underlying 1 million amount is never exchanged. It's only the interest rate payments that are being swapped between the 2 parties in this example here. How do we compute the market value of an interest rate swap? Well, that's very easy. I have 2 streams of payments. I have a stream of fixed payment and I have a stream of floating payments. So the market value of the fixed payment is the easiest because that's just a bunch of discounted cash flows. I'm going to pay the interest rate Y, the fixed interest rate Y, times the notional amount capital L. So in the previous example, that was 3% and capital L is 1 million. And then I'm going to make these fixed payments at time 1, at time 2, at time 3. The NPV of these 3 payments is just the sum of the 1-year discount factor plus the 2-year discount factor plus the 3-year discount factor. What is the market value of all the floating payments? Well, it turns out that the floating payments, I can use a replication argument by saying, if I invest my initial amount, my principal, into a money market deposit, so if I would invest 1 million euros in a money market deposit for a 6-month period, I am by definition, because that is what the Euribor rate is, I am by definition receiving this 2.1% interest rate over a half-year period. So with that interest rate, I could make this 10,500, and then I receive my 1 million back, and then I could reinvest this 1 million into another 6-month money market deposit. And so I invest, I make the payment, invest, I make the payment, invest, I make the payment, da, 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 da. So at time 3, after I have made this last LIBOR or Euribor payment, I am left with my 1 million euros. So what is the market value of all these floating payments? Well, I started with 1 million euros at time 0, and I ended up with 1 million euros at time 3. And the only thing I've done is I have paid all these floating rates along the way. So the market value of all these floating payments must be the difference in market value between starting with 1 million euros at time 0 and ending up with 1 million euros at time n. And there you see that I was relatively relaxed about it's a 3-month payment, or it's a 6-month payment, or it's overnight. Basically, the market doesn't care that much, because it doesn't matter how frequently, whether you are rolling over every 6 months or every 3 months, or even whether you are rolling over overnight. You can always use this same argument to just say, the only thing that matters is what's the amount of money I started at the beginning date minus the amount of money I am ending up at the end date. So even though we do not know what the future floating interest rates are going to be, I can already determine today at time small t what the NPV of all those unknown floating payments are going to be, because I can use this replication argument. I can roll over, I can always replicate a stream of floating payments by rolling over a given amount of money, or rolling over the amount of money, capital L, in a money market account. So what is now the total market value of a swap contract? Well, if it's a payer swap, from my perspective, then I am receiving the floating payments and I am paying out the fixed payments. So then the value is V flow minus V fix. And obviously, if this is a receiver swap, it's flipped, it's V fix minus V flow. Now, how are interest rate swaps being quoted in the market? The way that interest rate swaps are quoted in the market is by saying what fixed interest rate percentage for a 1-year contract, for a 2-year contract, for a 10-year contract, for a 20-year contract, which fixed interest rate in the interest rate swap gives the market value 0 now at today. So then it looks more like a forward contract, where the forward price is that price that makes the forward contract have a market value equal to 0 today. And this magical fixed rate that makes the contract equal to 0 is known as the par swap rate. How do we compute the par swap rate? Well, the total value of the swap should be equal to 0. So the value of the floating side should be equal to the value of the fixed side. Well, the value of the floating side is the principal times the difference between the 2 discount factors. And the value of the fixed side is the principal times the fixed interest rate, times the sum of all the discount factors. And if I set these two equal to each other, this is a linear equation in Y. So unlike with bonds, when you have to find a par coupon, you have to do a difficult computation or an internal rate of return. Finding the par swap rate is really easy, because this is just solving a linear equation. So the par swap rate for an n-year contract is the value of the floating side divided by the sum of these discount factors in the denominator. And the notation that I use is the YNT is the par swap rate for time to maturity capital N as we observe it today in the market at time small t. Now you may wonder, well, the initial discount factor is always equal to 1. So why does he use this difficult notation D0T? The reason that I do this is we can use this exactly same formula if we have a so-called forward starting swap contract. So I could look at time small t at the fixed interest rate for starting in year 3 and then going on to year 13. And then I have a 3-year forward starting 10-year swap rate. And then I can use the notation Y T0 Tn. So T0 denotes the start date of the swap. Tn denotes the end date of the swap. And the small t, and I will switch between these two notations because I get a lot of subscripts here. This denotes the calendar time where I am computing this forward par swap rate. And then if T0 is equal to 0, you basically delete this, and then we are back to our basically spot starting par swap rate. If we know the par swap rate, we can do a little bit of a shortcut to determine the market value of a swap contract, because if I have a so-called off-market swap, so if I have a swap contract with a fixed rate K that is different than the par swap rate, then I know that the floating sides of those two contracts are exactly the same. So the only difference in value comes from the fact that the fixed rate payment K is not equal to the par swap rate. So therefore, the market value of a payer swap is the difference between the par swap rate and the actual rate K that I'm paying. And this Y minus K, of course, I need to multiply with every time I make a fixed payment. So you can also compute the market value of a payer swap by saying I take Y minus K times the sum of the discount factors, and for a receiver swap I am receiving K, so then K is positive and I do K minus Y times the sum of the discount factors. And again, if K is equal to Y, then obviously this term is equal to 0, and then I recover the fact that a payer or a receiver swap both have market value 0 when the actual fixed rate K is equal to the par swap rate Y. Here are some examples for quotes for par swap rates. This is a Swedish bank, SEB Group, and they are friendly enough to quote par swap rates on their website. So you can go to their website, and if you type in the search area swap rates, they will show you the actual quote. So this was from yesterday, these quotes, and we see that the current market for swaps is still a little bit slightly negative interest rate. So this is minus 0.19% par swap rate for the 1-year swap, and then it is increasing up to somewhere around 1%, 1.15% for the 15-year swap, and then it's going down a little bit for the very long maturities. So the 30-year, if I want to engage into a 30-year payer swap, then I would be paying a fixed interest rate of 0.83%, so 83 basis points. And this is obviously the mid quote. So when you are paying, you pay a little bit more than the 0.83, let's say 0.84. And when you are receiving, you are getting a little bit less than the mid rate. So let's say 0.82. And that gap between the payer and the receiver rate, that's of course exactly the spread where SE Bank or where the broker is making their margin on. So let's take a look at a swaption. So a swaption is now an option on an interest rate swap. So when we have a payer swaption, this is the right, but not the obligation to start paying a fixed rate K on a swap that starts at time t0 and runs until maturity tn. So the timeline we are looking at is, I have 3 time points here. I am currently today at time small t. And then I'm looking ahead into the future at some date t0 where the underlying swap starts. And then I have a date tn where the underlying swap ends. So I can buy today at time small t the right to enter into a forward starting swap for the period from t0 until tn with a fixed rate k. And then at time t0, so at the start date of the swap, I can then decide whether I want to exercise this option, so whether I want to enter into the swap at that point in time, or whether I say, no, I have no interest and I let this option expire worthless. So when do I want to exercise my payer swaption? Well, if I have the right to start paying an interest rate of K, this will be interesting for me if the market interest rate Y is higher than the than the contract interest rate K that I have from my option. So at time t0, what is the market value or what is the payoff of a swaption? It is the amount of money, the notional L, times the sum of all the discount factors that represents all the fixed payments that I'm going to make. And then I'm going to use this formula y minus k. But since I have an option, I can exercise this only if y is larger than k, and then I will pick up the positive part of y minus k. And this red part is the option type of payoff, and you may recognize this. This is like a call option on the par swap rate. But unlike a normal equity option, if I enter into a swap, I'm not entering into one single amount of money. I am entering into a complete collection of payments that runs from time t0 until time tn. And the NPV of that collection of payments is being referenced or indicated by this summation here. And I see that I make a typo here because the time point at which I evaluate all these discount factors here should be capital T0. If I have a receiver swaption, then I have the right to start receiving an interest rate K, and then obviously I want to exercise the swaption if the rate that I receive, that the rate K that I receive is higher than the par swap rate Y. So a receiver swaption is similar to a put option on the par swap rate, which at time t0, I have the right to say whether I want to exercise this or not. So how do I compute the market value of a swaption? So a swaption is a European style option on the par swap rate with option exercise date time t0. And as I said earlier, a payer swaption is like a call option on the par swap rate, and the receiver swaption is like a put option on the par swap rate. And we see, hopefully you see the analogy with an option on a stock with a strike price K. So now we jump back to, I think, week 2, when we talked about no arbitrage pricing. What was the general scheme for no arbitrage pricing? The general scheme was, in step 1, we can choose a numeraire asset. And what was the requirement for a numeraire asset? It must be a traded asset in the economy, and it must have a strictly positive price. And then if I have chosen a numeraire, I can find a martingale measure, Q superscript n, that belongs to that numeraire, such that all the prices of traded assets divided by the numeraire become martingales. And if such a measure exists, the economy is arbitrage free. And this is actually a double implication error. I can also say, if I assume that the economy is arbitrage free, then it means that there must exist such a martingale measure. And then if I have selected this martingale measure, I can then use the martingale property to compute the price today at time small t of any other asset in the economy by taking a Qn expectation of the payoff divided by the numeraire, and then I take the conditional expectation at time small t. So we did this already for the Black-Scholes formula, but here for the interest rate derivatives, we can apply exactly this same theory, but this will be more sophisticated because we will use more fancy numeraires. Let's take a look at the swaption. So the swaption payoff has this sum of discount factors sitting in front, and then you have this swap payoff y minus k, or this option type of payoff y minus k. So let's choose this sum as the numeraire. So I'm going to introduce a special symbol, p t1 tn at time small t is the market value at time small t of the sum of these discount factors. So each individual discount factor is a traded asset. So therefore, the sum of discount factors is also a traded asset. And each discount factor individually already has a strictly positive price. So if I take a sum of discount factors, this has altogether also a strictly positive price. So therefore, I have a traded asset with a strictly positive price. So using the sum of discount factors, capital P, is a valid choice of numeraire, but it's quite a different choice of numeraire as we have seen for the Black-Scholes formula. And now I'm going to assume that this interest rate economy is arbitrage free. And that means there exists at least one martingale measure. And I will now use the notation Q with the superscript T1 Tn. And the T1 Tn, the double superscript, corresponds to the T1 Tn, which are the start and the end dates of this summation of all these discount factors. So if I use this measure Q T1 Tn, then all traded assets divided by this numeraire become martingales. A swaption is a traded asset in the economy. So therefore, I can compute the price at time small t, so the value of the payer swaption at time small t, divided by the value of the numeraire at time small t, is the Q T1 Tn expectation of the payoff of the swaption evaluated at the option exercise date time t0, and this was this max of y minus k times the sum of these discount factors, which is this p here, and I am dividing by this same p as a numeraire. And now you see why this is a clever choice of numeraire, because the sum of discount factors in the numerator very conveniently cancels against the sum of discount factors that I use as the numeraire. So therefore, I need to compute the small t expectation of this y minus k swap rate payoff at time capital T0. And by this clever choice of numeraire, my option calculation or my expectation calculation is like a normal call option on the par swap rate. So if I assume a probability distribution for the par swap rate, I am basically in business because I can now evaluate this call option payoff y minus k positive part. Obviously, this is the relative value of the swap, the payer swaption divided by the numeraire. So therefore, the price of the swaption itself is this expectation of y minus k times the numeraire evaluated at time small t. And now you can hopefully see a bit better why I was protesting against this idea, oh, it's a discounted payoff, because the numeraire that we are using here is a sum of discount factors. So the discounting that I'm doing is much more complicated, and it's really something else than just taking e to the power minus RT. So this was the reason I was pushing on this fact that we are not taking a discounted expectation, we are taking a martingale expectation of a payoff relative to a numeraire. And here we are using already a quite fancy numeraire where we are using the sum of discount factors as a numeraire. So now we have to compute this expectation here, this y minus k. Let us consider the stochastic process of the par swap rates. Well, what is the definition of the par swap rate? Well, the par swap rate, the forward par swap rate for a swap starting at time t0 and running until time tn was the value of the floating side divided by the sum of discount factors. And using our new notation, the first discount factor is dt0 and the last discount factor is dt capital N. And the sum of the discount factors runs from t1 until time tn, because at time t0, there is no initial fixed payment. This is a mistake that many people make. So the starting point of the swap is dt0, but the first fixed payment will actually fall at time t1. Now, if we look at the par swap rate, this is a traded asset, the difference between two discount factors, but that's a traded asset in the economy. And I'm dividing this by the numeraire. How nice. So the par swap rate is actually the price of a traded asset divided by the numeraire PT1TN that I was using anyway. So therefore the par swap rate itself is also a martingale under this QT1TN measure. So this is another reason why this choice of numeraire is really, really convenient, because first of all, I am canceling this sum of discount factors in the payoff. That was already nice. Secondly, the par swap rate that I'm interested in is also a martingale under this measure. Now, if I want to make a model for the stochastic process of the swap rates, I don't need to worry about doing a drift term or keeping this no arbitrage free. And I can directly model the par swap rate as a martingale process. And if you look at different types of models that people use for interest rates, then basically the only difference between any model for the interest rates is basically what specification do you use for the volatility function that you want to play with. Which stochastic process do I want to give to the par swap rate? And I can control the behavior of the stochastic process by this volatility function sigma ty. So what kind of choices can we make? Of course, you can do whatever you want, but let's say two very popular choices are you can model the par swap rates with a log normal martingale, and then sigma t of y is, for example, a constant sigma times the y itself, or maybe a time dependent, a deterministic sigma. So that's one choice. And then you get a log normal martingale for the par swap rates. And that means you get a Black and Scholes type of formula for the swaption prices. We can also use just a constant sigma or a deterministic sigma here. And then we will have a normal distribution for the, so then we have a Gaussian martingale. So then we have a martingale process for the par swap rate with normal distributions. And then we get a Gaussian option price. And Yoshi in his book talks about a more general form. This is known as CEV, the constant elasticity of variance process, where you say, I can model the volatility function as a deterministic part or a constant sigma times the swap rate raised to a constant number gamma. And obviously for gamma equal to 1, we get the log normal back. And for gamma equal to 0, we get the Gaussian process back. So this is kind of a generalization. So if we are modeling an interest rate model, you basically want to kind of choose which specification of the volatility process or the volatility function sigma ty kind of best fits the prices that you can observe in the markets. And it used to be the case that log normal specifications were very popular. The argument was interest rates cannot go negative, so the log normal is kind of is by definition living on the positive part. But in the last 10 years, we have seen significant negative interest rates, then up to almost -1%. So now let's say, Gaussian and normally distributed interest rate models have become much more popular in the euro area because it can capture the negative part of the interest rates. So if we would use a log normal specification, if we model the par swap rates as log normal martingales, then we are getting a Black and Scholes type of formula. So you get y times ND1 minus k times ND2 for a pair swaption. But you have to multiply with numeraire. So you are getting the sum of discount factors sitting in front here and not just one single e to the power minus RT term. And the D1 and the D2 term are basically what you expect. So this is the forward par swap rate divided by the strike plus or minus 1/2 sigma squared T minus T divided by sigma square root T minus T. Again, we do see that interest rates are negative. We are moving away from negative interest rates in the current state of the world. So we can also use a Gaussian model to model the par swap rates, and this will lead to a different pricing formula. The normal distribution is mathematically convenient to work with, but the normal distribution say, well, interest rates can cover the whole real line from plus 50% to minus 50%. And basically everybody agrees that yes, interest rates can go a bit negative, but interest rates cannot really become unbounded negative. So another way to kind of allow for a bit negative interest rates, but not say interest rates can go to minus 500%, is to use something like a shifted log normal model, where you say, I am modeling this as a log normal distribution, but I'm shifting this log normal distribution to start at, for example, a lower interest rate of minus 1%. And this is a very convenient way of kind of finding a compromise between the log normal distribution and the normal distribution. Again, it's a modeling assumption because the price you pay for this is that you are assuming that there is a rock solid hard lower bound and that interest rates can never fall below minus 1%. So as another variant, if we assume that the par swap rate has a constant volatility, so then we have, so the par swap rate is a Gaussian martingale, so it has normal distributions. Then the normal distribution option formula looks like this. So we get y minus k times capital N of D, and capital N is the cumulative normal distribution function evaluated in the argument D. And then I get another term, which is sigma times square root T minus T times phi of D, and the phi is the standard normal density function. And this D argument is y minus k divided by sigma square root T minus T. So this is the how many normal standard deviations the forward par swap rate is away from the strike. And again, this formula can be obtained from straightforward integration of this expectation here, given that I endow the par swap rate with a normal distribution with mean equal to the forward par swap rate that I see at current time, small t, and a variance equal to sigma squared times t minus t. Another type of contract that is very well known in the interest rate market are so-called caplets or floorlets. And a caplet is an option on a LIBOR rate. And the way we can look at a caplet is we can say an option on the LIBOR rate is like an option on a mini swap contract where there's only one fixed and floating payment. So to price caplets or floorlets, we can use exactly the same swaption formulas that we talked about earlier, that you saw in the previous slides, but we're going to choose T0 and T1 very close together, for example, 3 months apart or 6 months apart. So then you have this kind of mini swap where there's only one payment. So the mini swap starts at time T1 and already, starts at time T0 and already stops 3 months later or 6 months later at time T1. And then at time T1, only one floating and fixed payment are being exchanged against each other. And because we are doing this mini swap for very small time steps of half a year or less, we're going to make a small adjustment, is that we're going to use the par swap formula. So that is dt0 minus dt1 divided by the sum of the discount factors, where there's only one discount factor in the denominator, which is dt1. So this would give us the correct formula, but this would be an interest rate for a half-year period. And the standard convention in the market is that interest rates are quoted in per annum equivalents. So therefore, I am using this small time step of 3 months or 6 months in the denominator to kind of blow up the half-year or the quarter-year interest rate back to a 1-year equivalent. So this factor 1 over delta t is like the factor that is needed to scale up the interest rate to an annual rate. But later, when you saw that earlier in the swap cash flows example, then at the later, when I'm computing the actual interest rate amount that I'm getting, I will then multiply the forward interest rate again with this delta t amount to make it back, to scale it back to the half or the quarter year periods. And then a caplet is a call option on this forward LIBOR rate. And because the forward LIBOR rate makes a payment at time dt1, at the end of this T0, T1 interval, I am using dt1 as the numeraire. This is also a tricky bit. Although the forward rate, the LIBOR rate, is fixed at the beginning of the period, the actual payment, because you are earning the interest rate over this whole time interval, the actual payment is only done at the end of the period at time T1. So therefore I must use dt1 as my numeraire. So now I'm going to move to the next step, and I'm basically going to bring all these instruments together. So it is really great that we have all these nice and clean closed form pricing formulas for swaptions with different T1, Tn combinations, and for cap and floor contracts with different T0, T1. But there is a but. This clever choice of numeraire that we are making has a flip side, because it means that for each individual swaption or cap or floorlet contract that we are pricing, we are using a different numeraire. So the clever choice of numeraire is a different choice of numeraire for each individual swaption or caplet. So each T1 Tn pair that we are using induces a different martingale measure QT1 Tn. So for simple European options, this is very convenient. But if we want to model a more complicated interest rate product, we want to look at multiple interest rates simultaneously in the same model, and therefore we want to model multiple interest rates simultaneously under one single probability measure. So how can we do that? Well, this gives another tool that we talked about already early in the class. I'm basically bringing everything a little bit together here. Is we can use this change of measure and change of numeraire technique. So the way we can model multiple interest rates simultaneously under one single probability measure is by using change of measure methods. So the volatility of the numeraire ratio, if I'm changing a probability measure, then I should look at the ratio of numeraires that belongs to these two measures, to these two martingale measures, and the volatility of that numeraire ratio, that was with Gersano's theorem, that is the drift adjustment to the Brownian motion that we need to kind of look at the impact of doing a change in probability measure. And the numeraires are traded assets in the economy. So I can basically use Ito's lemma to work out what the volatilities are of these numeraire ratios. And therefore, I can use Ito's lemma and Gersano's theorem to work out explicitly what these drift adjustments are. And if I do this carefully, then I can determine what the stochastic differential equation is for each individual rate under the same probability measure. But the price that I'm paying for this in these market models is that the drift terms become fairly complicated. But I do know the stochastic differential equations explicitly. And if I know the stochastic differential equations for all the interest rates, I can then use Monte Carlo simulation to simulate paths for all these interest rates with these complicated drift terms. And if I have paths for all the interest rates, then I can basically know at each point in time the complete term structure of interest rates, all the discount factors, and therefore I can compute the value of any option that I want at any point in time along each time point along my simulated path. Let's take a look at what is known as a LIBOR market model. So in a LIBOR market model, we are going to start with a collection of forward LIBOR rates. For example, if we follow the Euro convention, we're going to take a number of LIBOR payment dates that are spaced half a year apart. So I'm going to slightly simplify my notation here. I'm going to model a series of payment dates, T sub I, and each I is I times delta T. So there I have this collection of payment dates which are, for example, spaced half a year apart. And I'm going to follow capital N of these payment dates, and I'm going to model then capital N of these forward LIBOR rates. So each forward LIBOR rate, and again, I'm simplifying the notation a little bit, I'm saying the forward LIBOR rate for time point Ti, so actually for the time interval Ti to Ti plus 1, I will denote this forward LIBOR rate with F sub I. The market value at time small t of this forward LIBOR rate is di of t minus di plus 1t divided by di plus 1t times delta t. So this is this delta t correction. And you see the di plus 1 in the numerator and the denominator. So I can alternatively represent this as 1 over delta t times the di over di plus 1 minus 1. And again, I am simplifying the notation a little bit. So each d sub I means the discount factor with maturity date I delta t that I observe at calendar time small t. And what we know is that each forward LIBOR rate Fi is a martingale under its own probability measure Qi plus 1. And the martingale measure Q superscript I plus 1 belongs to the choice of numeraire discount factor with maturity t I plus 1. And because each Fi is a martingale under its own probability measure, I can model each LIBOR rate as a martingale by specifying this volatility function sigma I of t, and this can be again log normal by saying it's sigma I of t times f, or it can be Gaussian by taking a deterministic sigma I of t, or you can do a CEV or a shifted log normal. Here, I will use kind of a bit of a Gaussian type of notation, or sigma I of t can also indicate a general stochastic process. And then the nice thing is about a LIBOR market model is I can calibrate each volatility sigma I that belongs to each forward LIBOR rate by taking the market prices of caplets that are quoted in the market. So the caplets are instruments that are actually traded in the financial market. And I can see market prices quoted for these instruments. And then if I have my favorite caplet pricing formula, let's say a Gaussian caplet pricing formula, I can then search for the numerical value of sigma I that matches my model price. I can then compute the implied volatility such that the model price for my caplet price actually matches the market price of the caplet as I see it currently quoted in the market. So this is the connection that I'm going to make, is that these sigma I numbers are, let's say, kind of directly observable in the market as the implied volatilities that will match my theoretical caplet price formula to the market prices that I see quoted in the markets. So I now have these sigma I functions, these sigma I quantities for each individual forward LIBOR rate, or that I extract from all the caplet prices. But as I said earlier, the price that I'm paying is that each individual LIBOR rate lives under its own probability measure QI plus 1. But I also want to measure Fi and Fj and Fk for all these different values for I is 1 to capital N. So I want to bring all these forward LIBOR rates under the same martingale measure. And what is a nice choice to make is, let's consider a one-step change of measure. So what's the relationship, or if I want to change from the QI probability measure to the QI plus 1 probability measure, the Radon-Nikodym derivative that belongs to this one-step change of measure is the ratio of the numeraires, and the numeraire for the QI measure is the discount factor DI, and the numeraire for the QI plus 1 measure is the discount factor DI plus 1. But this ratio of DI over DI plus 1 is actually a very simple formula of the forward LIBOR rate. It's 1 plus delta T times the LIBOR rate Fi. So the numeraire ratio, DI over DI plus 1, is a very clean function of the forward LIBOR rates 1 plus delta T Fi. So therefore, because I have postulated I'm modeling those LIBOR rates, so I know the stochastic processes for the Fs, I can now apply Ito's lemma to 1 plus delta T. Well, this is the easiest application of Ito's lemma, because this is just a linear function. So the D of 1 plus delta Tf is delta T times sigma I times the dW, and because F is a martingale under the QI plus 1 measure. Now, if I want to apply Gersano's theorem, I need to extract the volatility. And how do I extract the volatility? Well, the volatility is the log normal specification of this process. That's how I extract the volatility. Well, how do I get a log normal specification? I just simply multiply and divide by my Radon-Nikodym derivative. So now the term in red, that is the volatility of the strictly positive Radon-Nikodym process. So this term here, this red term, is the volatility of the Radon-Nikodym derivative process, and therefore this volatility term here is the drift adjustment that I can use in Gersano's theorem. So how did Gersano's theorem work? By saying, if I'm changing from measure QI plus 1 to QI, that means that the Brownian motion, the stochastic process that was a Brownian motion under measure QI plus 1, minus this red drift term here. Oh, there should be a dt here. I apologize for that mistake. So that's slide 26, dt. The Brownian motion, that the stochastic process that was a Brownian motion under measure QI plus 1 minus this red drift term, that will become a pure Brownian motion without drift term under the new measure QI. So this one-step change of measure, using the forward LIBOR rate as a nice function of the numeraire ratio, I can then use the volatility of this 1 plus delta TF process, and that gives me the drift adjustment term of the Brownian motion if I go from Brownian motion QI to Brownian motion QI plus 1. Now I am more ambitious and I want to model all the LIBOR rates for all the i's under one and the same probability measure. And a convenient choice of probability measure is to use the final measure Q superscript n. So this is the last date that I'm modeling in my LIBOR market model. And that last date has d sub n as a numeraire. And why is this a nice choice? Well, this is the last discount factor that I'm modeling. And therefore, when I'm moving forward through time, this last discount factor is a numeraire that is always available right until the last moment, T capital N. So how can I now model the forward LIBOR rate Fi under the measure Q superscript n? Well, the trick to do this is to say I know how to do a one-step change of measure. So if I want to go from QI plus 1 to Qn, I can do multiple one-steps changes of measure. So I can go from QI plus 1 to QI plus 2, from QI plus 2 to QI plus 3, to from Q capital N minus 1 to Q capital N. And each time that I apply a one-step change of measure, I pick up another drift term of the form minus delta t sigma k 1 plus delta t fk. So therefore, the I LIBOR rate Fi modeled under the measure Q superscript n is no longer a martingale, but I know what the drift term is from the repeated application of Gersano's theorem for all these measure changes. And the first measure change is going from Qi plus 1 to Qi plus 2. And the last one is going from Qn minus 1 to n. So all the terms that I see in the denominator here are I plus 1, I plus 2, until capital N minus 1. So all the drift terms that I have picked up along the way is the summation for k is I plus 1, the first change of measure, to up until capital N minus 1, that's the last change of measure. And then each drift term that I pick up is minus delta t sigma k 1 plus delta t fk. And that is all the drift terms that are sitting implicitly in this Brownian motion. And of course, I am pre-multiplying this Brownian motion with sigma I, so all these drift terms together are multiplied with the sigma I of t term. And this formula here, that is the stochastic differential equation for the ith LIBOR rate under the Qn probability measure. And of course, I can now apply this formula for all choices of I, and I've now measured all my LIBOR rates together under the same probability measure. And of course, the price that I pay for that is that since I've moved all these LIBOR rates away from their natural measure, from their own probability measure, they are no longer martingales, but I know very explicitly what the correct drift term specification is. And we see that the drift term is non-trivial because I have these 1 plus delta t fk's. So the drift term of the ith LIBOR rate depends on the value of all the other LIBOR rates beyond time point I. This is a bit of a complicated setup, or more complicated than you have seen, because I am simultaneously modeling all these LIBOR rates together. And this is more fancy than what we did with the Black and Scholes model, where we are basically just looking at one stock price and that's it. So here I am simultaneously keeping track of multiple stochastic processes. So let's illustrate this a bit more explicitly. So the picture here shows an example of one single Monte Carlo path in the LIBOR market model. And in this simplified example, I'm taking 1 year time step. So I'm using 1 year LIBOR rates. And I am taking time point 6 as my final time point. And I'm also tracking 6 LIBOR rates in this model simultaneously. So the LIBOR rates that I'm tracking are these 6 LIBOR rates numbered from LIBOR rate 0, LIBOR rate 1, until LIBOR rate 5. So this is the F0, F1, F2, F3, F4, F5, as I observe them at time point 0. And how do I start off my LIBOR market model? At time 0, I can observe the current term structure of interest rates. Typically, I observe that in the form of discount factors. And from these discount factors, using my LIBOR definition formula, it was over here, I can basically compute what are the forward LIBOR rates at time 0, given the initial term structure of interest rate that I observe in today's market. So I observe the term structure of interest rates, and from that, I compute my initial forward LIBOR rates. In this toy example, they're all equal to 5%. And each forward LIBOR rate, I know what the volatility each individual LIBOR rate is, because I am extracting that as the implied volatilities from the market prices of caplets. And given that I specified my sigmas and where the F process or each FI process starts at time 0, I basically have a complete model. So I know where my F processes start at time 0. I know what the sigmas are for each F process. I'm not showing them explicitly here, but I know what my sigmas are. And now I can draw a path from my Monte Carlo. Here in this example, I'm just using a one-factor model, which means I only have one Brownian motion that drives all the LIBOR rates. So the purple numbers here are the delta W's, so that's the change in the Brownian motion value, which is normally distributed with mean 0 and with variant delta T. So these are just N01 numbers. So these purple numbers are just, these are the random numbers that I draw. And how do I now move my LIBOR market model forward? Well, I'm simultaneously modeling all these LIBOR rates F0, F1, F2, F3, F4, F5. Well, F0 is a bit, let's say, not very interesting, because F0 is the current spot LIBOR rate. So that process is basically done at time 0 already. So actually, I'm only modeling 5 LIBOR rates. Now, if I take one time step forward, I'm taking a horizontal step here. So I'm moving along a row. And to move this stochastic process forward, I am using this stochastic rate, this stochastic differential equation here, this particular drift term, and of course the realized value of this Brownian motion. So I am using this value 0.8385 for the delta W value, and then I'm taking an Euler approximation, and I'm shifting my LIBOR rate forward with the stochastic differential equation. So that's how I do a horizontal step forward. The horizontal step is a step forward in time. And for that, I use the stochastic differential equations and the simulated Brownian motion value. By taking one time step forward, I am generating new random variables for all my forward LIBOR rates. And with the forward LIBOR rates, I can now compute what the new term structure of interest rates is by basically moving down a column. So I'm taking a step forward in time using the stochastic differential equation. I'm simultaneously generating a new collection of forward LIBOR rates. And with the forward LIBOR rates, I can generate a new term structure of interest rates. How do I generate a term structure of interest rates? Well, the discount factor at calendar time 1 with maturity date 1 always has a value of 1. So you see all these values of 1 sitting at the diagonal. And then every maturity step that I take forward, I use, again, the LIBOR definition, but kind of flipped around. I can say that D for the maturity I plus 1 at time slice small t is the DI that I have divided by 1 plus delta TF. So this number here, this number here, 9459, is 1 divided by 1 plus 5.72. And if you compute that number, you see those numbers here. And then I have the complete term structure of interest rates at time 1. And with the complete term structure of interest rates, I can then price any derivative that I'm interested in. For example, suppose I want to calculate the payoff of a payer swaption at time t is 2 on a 4-year swap with a strike of 4% and a notional of 100. Well, if I am at time t is 2, I have pushed my LIBOR market model 2 time steps forward in time. So then I have only 4 LIBOR rates left, which are kind of still alive and looking into the future. And with these 4 LIBOR rates that are left, I can compute these 5 discount factors for looking forward from time 2 to time 3, time 4, time 5, time 6. Now, if I want to compute a swaption, I first want to compute this sum of discount factors. So I am at time 2, and I'm looking at a 4-year swap that is going from time 2 to time 6. What are all the fixed payments that I will encounter between time 2 and time 6? Well, these are the discount factors at time 3, 4, 5, and 6. So the PVBP that I'm using, or the sum of discount factors term capital P, is the P36, as I observe it at calendar time 2. And the P36 at calendar time 2 is the sum of 0.9570, 0.9155, 0.8755, 0.8368. And if I add these numbers together, I get the value 3.5848. I can now also compute the par swap rate. So the par swap rate at calendar time 2 for a swap contract that starts at time 2 and runs until time 6 is the discount factor D22, which is 1, minus the final discount factor 0.8368. So this is 1 minus 0.8368 divided by the sum of discount factors 3.5848. If I compute that number, I get 0.0455, so that's 4.55%. So what is the payoff of this payer swaption? I have an amount of money 100, and the payoff was the positive difference between y minus k, positive part, a little plus here, times this sum of discount factors times the original amount of money. Well, the notional amount of money is 100. The sum of discount factors is this 358, and the value of the payer swap is this positive difference between the 4.5% and the 4%. And if I compute this number, I get a value of 1.97 euros. But I have to take care of my numeraire. What is my numeraire? Well, the numeraire is this 6-year discount factor that is living here on this bottom row. So what is the value of the numeraire at time 2 is the value of the 6-year discount factor at calendar time 2, and this is this 8368. So I take my payoff of 1.97 and I divide this by the numeraire, and this gives me a value of 2.36. And this 2.36 would be that would be the relative value of this payer swaption at time t is 2 in this one particular simulated path of the Monte Carlo simulation. So then I repeat this calculation with 10,000 or 100,000 random numbers, or 10,000 or 100,000 paths. And then I take the average of the payoffs over all these simulated paths. And then again, a mistake that many students make, they are so happy that they are done with the calculation, they just report the average of those paths. But the average over the path that we have computed here is the value divided by the numeraire. So the average of all the swaption values that I compute in the Monte Carlo simulation I have to translate this back to a euro amount by multiplying the average over all the simulated paths of all those payoffs, of those payoff options, with the initial value of the numeraire, which is D60, which is this 0.7462. So that is kind of how you do a total, that is the complete sequence of steps of how you compute prices of any interest rate option that you are interested in this LIBOR market model setting with a Monte Carlo approach. And that, I think, ends this presentation here.